Hello guys, thank you very much for joining in. We're going to be starting out with the second part of this chapter where the focus is on, we have already talked about different types of fund. Okay, we talked about the master fund, the feeder fund in the previous session. And now we're going to be moving more into the details of the structure of the documents that you have to sign. Okay, when you enter into the partnership firm or basically a master partnership firm likewise. Okay, so all of this is connected to your alternative investment strategies. Let us look at the key legal documentation which you have to fill in a limited partnership structure. First is the offering memorandum, okay, which you have to remember. So private placement memorandum is this is what generally called as private placement memorandum, which basically tells you that why you have created a partnership. Okay, it basically highlights that what are the different opportunities that you're going to be looking at, how the overall risk and the funds are managed. Okay, so if I'm creating a hedge fund and planning to raise 500 crores, I will write down that, okay, if I'm going to take the money from the investor, how exactly I'm going to utilize the money, what is the strategy that I have, what approach I'm going to use, how I'm going to calculate the expected return, how I'm going to manage the overall risk. Okay, so offering memorandum is basically sent out to the investor. Okay, it is kind of a marketing tool where the investor will look at the document, will ask questions, and then will take a decision whether to invest or not. The main agreement is this similar to what you have a partnership agreement between two people. Okay, over here there is general partner, there is limited partner. We have already talked about this. Limited partner is somebody who is investing the money. General partner is somebody who is managing the money. He's managing the overall operation. He's taking the decision where to invest, right? So when you're defining that who is going to be a limited partner, who is going to be a general partner, you have to write down what is the right, what is the responsibility of each partner. This is very, very important, because if suppose there is a general partner available and you have not mentioned that he's going to be looking for investment opportunities, okay, capital is allotted, but whether how the investment opportunity will be looked at, you have to mention that in the document. So each party's rights and responsibility has to be there. Fee calculation, that means if there is a general partner, he is given say 2 plus 20%, 2% is the management fee, then you have the profit sharing fee, which is the incentive fee. Then you have to mention it clearly. Okay, then you have to mention it clearly that this is how the calculation of the fee is going to be. So that document, the limited liability partnership agreement, okay, is the core document over here. Offering memorandum is more of a marketing, because you're making a private placement. That means you're looking for money from investor directly. It's a private investment that is happening. Subscription agreement, okay, this is also discussed a lot of time when you do enter into an investment opportunity. Okay, over here the limited liability partners, okay, in some cases some hedge fund structure, the limited liability partner will only make a commitment. Okay, that means he's going to make a commitment that I'm going to invest say 10 crores. He might not give the money immediately. Okay, he might give the money as the investment opportunities are available. So over here this document tells you that how much subscription the limited partner has actually made, how much commitment he has actually made, and how the funds will come from that limited partner into the private equity fund or into the hedge fund. Okay, so subscription agreement tells what is the intention of each limited partner. Management operating agreement, this is basically kind of an SOP. Okay, how the actual working of that private equity fund or an hedge fund will work. Okay, within the structure, with how the company is going to get operated and how the distribution will happen. So when we are saying distribution of profit, you might have to calculate, you might have to do accounting, you might have to do some information sharing. All of these activities will be mentioned over there in the operating agreement topic. Okay, so I'm just taking a short pause. Okay, let me know if there is any confusion, any query till this point. I hope everybody is doing good. Do we have any template? No, general template can be followed, but most of the time it is being customized depending upon what is the requirement of the investors. Let us move forward. Again, we are coming back to the agreement. Okay, this is the main point that you need to remember. Okay, this is an agreement. The way you can create a partnership firm, similar to that, there is a partnership agreement between the limited partner and the general partner. It's a proper legal contract where you're going to be highlighting how much capital the LP is going to contribute, how much activity the GP is going to do. Everything is written in the terms and conditions of that agreement. Now, why do we need this? Because if you want to make sure that the partnership firm runs successfully, you need to have a limited partnership agreement. Okay, and this contract also aligns. See the line. Main goal is to align the interest of the LPs and the fund. Everything is written down. Then it is easy. Then it is easy for the structure to operate properly. Then you know that what is expected from LP, what is expected from GP. Okay. If there is any mismatch, or if there is any confusion in the terms and condition, it can create future problems. Okay. Proper alignment will ensure what? That wherever the investment is happening, it is happening hassle free. There is no conflict between LP and GP. Okay. There is no confusion that what is expected from general partner in terms of the management, in terms of the investment opportunities, and there is going to be a trust between both the parties. Okay, so general partners who are actually the fund managers, who are actually managing the overall activities of the fund and taking day-to-day decisions. Okay, the limited partners who are investing capital, they should have the trust. And this trust is based on that agreement, because whatever is written in the agreement, it has to be followed. So like I said, it is generally customized. It is generally customized. I'm taking one more small pause, read till this point. I hope everybody is doing good. Varun, it seems you have joined from two devices. Kindly log out from one, because I can see it over here too, or else it will automatically get logged out and then you won't be able to log in again. I hope everybody is doing good. Okay, let us go to the next part. When we talk about the limited partnership, what are the major risks that you can face? Mark all of them as star. Okay, and these risks are important. Okay, from the exam perspective also. What is adverse selection? Okay, I selected a wrong fund manager, right? So I thought that this fund manager will be able to do extraordinarily good. He has good network in the market, he has good knowledge. But when he joined, okay, you realize that this fund manager is only doing shosha, right? So there could be a poor fund manager coming in, because of which your overall investment approach is delayed. Secondly, you might have to pay him the fees also, the management fee and all, right? Example, LP picks up a private equity fund because of low fee, but the GP lacks expertise, leading to poor investment. So you might have chosen a fund manager with a low fee, assuming that he'll be able to perform, but the logic is that since he's charging fee, he does not have the expertise, and it end up taking a wrong decision. This is very common. Even if you hire somebody in your company, there can be chances of adverse selection, right? What is moral hazard? Okay, moral hazard is very simple. Whoever is managing the fund is taking extraordinarily heavy risk. Limited partners are not having the appetite to that much level of risk. Okay, now why is he doing that? Because he feels that if I'm going to take extraordinary amount of risk, returns will be higher and I'll be able to make bonus or incentive payment, or I'll be able to earn that, right? So excessive risk, okay, is taken. That leads to a moral hazard situation. Please remember these points. Adverse selection, moral hazard, very, very important. Okay. Hold a problem. That means there is a mismatch in terms of the agreement between the LP and the GP, and they are not cooperating. So for example, the general partner or the fund manager has identified a company to invest, for example, say Flipkart, okay, but LPs are not releasing money, and because of which your time is getting delayed and you lose the opportunity to invest, right? An example, LP refused to provide additional capital because they believe the GP will gain more control. Over here, that is a trust issue, and because of which you end up facing hold up problem. Okay, this is important, and hence I'm taking a pause over here, asking you guys to read. I hope everybody is doing good. Okay, let us move forward. Few important clauses in the agreement: economic term clause, how the money is going to get distributed. Okay, how the actual profit will be distributed. So generally we follow waterfall structure. Okay, now this waterfall structure is going to come in detail. Okay, so in the later part of the chapters and the further chapters also. Okay, basically it highlights that if suppose you've there was a private equity fund, they had made an investment into a company, and now they've sold that stake, the money is coming back. How you're going to make sure that the money goes to the individual investor? Is it going to be on pro rata basis, or only certain investors are paid first? Okay, next, whether the how the investment or how the management fee or incentive fee is paid. Okay, is the management fee paid at the start, or is it paid at the end? Incentive fees, is it paid annually, or is it paid when the money is received from the investment? Okay, so all of this has to be identified. Second point, look at this: management fee and expense. So when I'm paying you a management fee, okay, in the contract it should be mentioned that this money should be utilized for XYZ activity. One of the common activity is the salaries of the GP. The fund manager is going to draw some salary, right? That is going to come from that management fee part. There's going to be rent of the office. Okay, there might be some marketing expenses that has to be managed by that GP from that management fee. GP's capital contribution, like if you remember in the previous part of the chapter also, I mentioned that in some cases, see, LP is going to invest capital, but in some cases the general partner can invest. Now if you want to make it mandatory, you'll have to write it down in the agreement that each general partner or each fund manager is going to contribute X amount into the fund. Why do we need this? Because now the fund manager's money is also invested into the fund, so he is going to take appropriate steps to mitigate the risk and get good returns for the investor, right? So economic term clause also interesting. Investor protection clause. Okay, say for example in the fund, the investors, the limited partners, they have highlighted that you cannot invest into a company which is into alcohol. Okay, or company we cannot invest into commodities, for example. So you have made some restriction that where the investment will go. You can also make a key person provision. For example, I have a fund manager Shubham, okay, and Rennie. Both of them are star fund managers. If tomorrow they leave the organization, how will we manage? Right? So you have to write down the contract that if this key person goes, what is going to happen to the fund? Are we going to restructure it or are we going to close it? Okay. Conflict of interest and termination rules. If there is any dispute, how the dispute will be managed? Will we get third party person? Okay, or will there be a trustee in between who's going to manage it? All of these pointers has to be written down in the contract. Okay, last 2 points are important, market as star. Okay, disclosure requirements. So LPs who have invested capital, similar to what, suppose if you also invest capital, and suppose Shubham is our fund manager. Okay, so obviously you will expect that Shubham will give you monthly reports, okay, quarterly reports, or any basic information to maintain transparency between the LP and the GP that yes, my money is getting invested appropriately. Okay, what is this reinvestment and clawback clause? Okay, sometime, okay, you can give an option to the LP okay, that okay, you have got the money back. Now if you want to reinvest, you can reinvest at this rate, okay, or you can come back and reinvest more money into the fund if obviously the LP has more confidence. What is a clawback clause? Clawback clause is very simple. Think about like this. Suppose we have Rahul. He is the fund manager. Okay, in 1 year, he made extraordinary profit. He's got the incentive. But next year, he started performing bad. Okay, the fund is losing money. So what you can do is you can mention it in the contract from the start that there is a clawback provision. If you make wrong decisions and if you lose money, whatever incentive we have paid in the previous year, we can get it back, we can claw it back. Okay, this is a very, very important clause. Okay, and a lot of big organization, irrespective of this hedge fund or private equity, if you're sitting in a top management role, okay, like for example, I think so this happened in Chanda Kochar case also, when this the fraud of Videocon came out in ICICI Bank. They had clawed back the bonuses for last 10 years from her, okay, which was I think so around 200-300 crores. So these are the key clauses which you need to remember. I'm going to take one more quick pause, read till this point. Let me know if there is any confusion. I hope everybody is reading. Let us look at the next part. Governance in private funds. Okay, there could be a limited partners advisory committee. Now, why do we need this advisory committee? Now, suppose if we only give general partner an entire decision making approach, there could be a chance that they might misuse it or they might not do it correctly. So there could be a advisory committee created by all the initial investors who are nothing but the limited partners. Now what they're going to do is they're kind of an oversight. When they're giving an oversight, they're basically checking that everything in the fund is happening properly or not. So they might look at how the decisions are happening with respect to investment. What is the strategy being used? Is there any extensions? Extensions over here means, are we delaying the payment? Are we extending the time frame of investment activity? Why is it happening? Now this is basically being highlighted, or this committee is basically being created so that the limited partners who are investing capital has some clarity that how the actual working of the fund is happening without intervening in the day-to-day activity directly. So it is only a committee which is overlooking it. Okay. Voting rules for LP. Now this both mark as star. Okay. Simple majority is very basic. The way you see in parliament also, if there is more than 50% of people agreeing to certain thing, the bill will be passed. Similarly over here, if there is any change or any decision that has to be taken within the fund, okay, so LPs have the voting right. So over here, simple majority is nothing but 50% plus 1. So if there are 100 votes, anybody who is any decision which gets more than 50% of the vote, then they are going to get the decision will be passed. Okay. Then you look at qualified majority. Okay, it requires for significant change like altering investment strategy or extending the fund term. This is very, very important. You can think of it like that you're basically changing the structure of the fund. When you're changing the structure of the fund, you cannot just rely on the simple majority. You need to have that good amount of quorum, which is around 75% of the votes. Then only a major change can happen in the structure. Look at this, extending the fund terms. Suppose initially the fund was supposed to be only for 5 years. Now, because of some change in the market or some downturn, you're saying, okay, we will extend it for more 3 years. So investors will get the money late. So it has to be approved by all of them. Okay. Why LPs avoid too much control? See, their aim is to provide capital and bank on the expertise of the general partner. Okay. But they look at transparency, they look at advisory. They do not want to get into the day-to-day activity, or else the fund investment will happen as per their requirement. But we want the GP or the fund manager to use his logic, use his expertise to invest. Okay. If an LP exercises too much control, they could lose their limited liability protection from the tax perspective also, because then you're actually participating into the business. Okay, and from that perspective, you will not remain a limited partner, you will become a general partner. And if you remember, general partners have unlimited liability. They do not want to have that. Okay, I'm taking a pause, read this entire section. Shubham, answering to your query, this advisory committee, is it formed only on the basis of who has invested high amount? No, it is basically comprised of all the LPs. Okay, they can come and become a part of that committee. Okay, or else they can choose a few limited partners who might go and do the advisory work. So it all depends. Okay, whether the size of the limited partner is very low or whether it is too big. Let us move forward. Fund must balance flexibility and clarity in their objective. That means how I'm going to invest, okay, and what is the strategy that I'm going to use. For example, you are using a long-term investing strategy where you will buy the company and you will wait, the way Warren Buffett does, right? But suppose suddenly in the market, tech companies or e-com companies, their values are going up and you might be tempted, okay? But if your strategy is clear, if your goal is clear, okay, you know that your strategy is going to give a long-term risk-adjusted return, so you will focus only on that. So that's the reason the clear objectives for the fund manager is very important. Okay, fund side consideration. That means how big the fund can be, how much money that fund can have. First and very simple is how much money investment opportunity is available. Second, committed capital from the LP. That first point is basically saying how good is the market. Okay, what is the opportunity available in the market, okay, to invest. That means if I have the funds today, whether there are actually opportunities to invest and make money. If there is no investment opportunity, there is no need to have a very big fund available with me, right? Second, how much is the commitment made by the limited partners and how much big you have the management resource. This is nothing but, suppose I want to do investing of 1,000 crore in a year, but my team members are only 3. That means I do not have human resource who's going to manage the entire fund investing, right? So it is going to be very difficult. So if you're saying that, okay, how big is my firm? It all depends upon factors. Okay, whether the market has that opportunity, whether the funds are available to be invested, okay, whether I have a good team or not. Private equity fund typically has around 7 to 10 years with extension in the years. Okay, so you can have the investment horizon increase by 3-4 years. Hedge funds generally are open-ended but can be closed at the GP's discretion. Why this is GP's discretion? Because he is the main person who's taking the decision. If today he is taking a decision to retire, then the limited partners ideally will close. They can get a substitute, but generally it is very difficult. So they will close the fund. Extension rules. Okay, if you remember over here we said there can be an extension of 3 years. But for doing that also, you'll have to take in voting. Okay, it can be a majority vote for LP because you're changing the structure of the fund. So you need 75% of more weightage, because for next 3 years, you'll have to pay the management fee. You can have a voting and say that, okay, we are okay to extend it for more 3 years, but we will not pay a management fee of 2%. I'll pay only 1%. You can negotiate with the GP accordingly. Read this paragraph. Is the meeting with the limited partnership agreement advisory committee held like quarterly or yearly? So generally it is quarterly basis. Okay, but if there is no investment that has happened during that period, then you can skip it for half yearly also. Right? Let us move forward. Now, management fee. This is the main crux of your hedge fund or PE structure, right? How the money is going to be paid to your GPs. Okay, so we have already talked about this. See, management fee covers your expenses, salary, fund administration, all the management related activity. Now the problem is, if suppose I keep very high management fee, what will happen? Most of the money will go towards the fund manager in terms of salary. My return would actually go down. But if I keep the management fee very low, the fund manager will not be able to perform his activity properly because he need money, okay, to identify opportunities. He need people who do the work, right? So over here, mark this as star. Okay, what is the impact of having management fee too high or too low? Performance fee, also called as carried interest. Remember this for the exam. Carried interest is nothing but the incentive which we are going to pay to the invest or basically GP. Okay, so it can generally be, like I said, 2 plus 20%. If the fund performs, 20% of the returns are given to him, right? Now there can be variations into this. A very simple example is mentioned here. If a private equity fund earns 15%, then the GP will receive 20% of the profit above hurdle rate. Okay, so above hurdle rate, how much percentage is there? 77%, and 20% of that, which is 1.4%, is something which will go to the GP. So over here, what they have mentioned that, okay, I will give you the incentive, but you will have to beat that hurdle rate of 8%. You will have to generate the returns greater than that. And the manager has been able to do that, and hence is getting that incentive fee. Okay. Now in the book, you have they've given you a paragraph talking about different regulations, are talking about, I do not expect it to be tested heavily in the exam. Okay, so I've just summarized it so it is easy for you to read and walk through that content. Okay, so different regions, what are the regulations that are being mentioned? Most famous of this is MiFID. Okay, MiFID 1 and MiFID 2. Okay, which is widely used by global banks also. Standardized rule for investment management. Okay, you can read this entire section. We'll be moving towards the next part, offshore fund structure. Now over here, there is one more in this last part. They've talked about Cayman Island. Cayman Island is nothing but tax haven. Okay, one of the tax havens which are there in the world. Okay, so companies create offshore funds. Okay, and through that fund, they basically make investment. Okay, so a lot of these investment management funds or private equity funds, they use offshore jurisdiction where the taxes are very low, where the regulatory requirements are very low. Main thing is taxes. Okay, so why they want to use this offshore fund? Okay, basically they want to register their fund in Cayman Islands or Isle of Man or Mauritius, all of these countries, right? Because of the lower tax burdens for international investors, they want to avoid that. Okay, fewer regulation. These are the first two which are very important points. Because if you, for example, if you're a US investor and you want to invest money into US market itself and the fund is registered there, then you might have to do some information to the tax authorities, government authorities, the regulators, so many things. Okay, if you want to avoid all of this, you can invest in an offshore account. Designated for high net worth individual and institutional investors who have the appetite to take the risk of investing outside. Okay, if you remember in the previous part, we had already talked about the master feeder fund. Okay, what was the feeder fund? Feeder fund is, think of it as a collection center. So you might have a separate feeder fund for US investors, separate feeder fund for Indian investors. So investors are putting money into that feeder fund, and then from that feeder fund, it is going to the master fund, which is registered in Cayman Island. And through that master fund, the money is going to get invested into different companies. Okay, this is the one part which you have already covered in the previous section. Limited partner, limited company or limited partnership, depending upon, this was also covered. Do you want to create a private limited company or do you want to create a limited partnership company? Okay, so we talked about different structures using different types of companies using different types of structure. Okay, I'm taking a quick pause. Any query till this point? Let me know if there is any query. All good. Let us look at this first question. Deepika Anand is negotiating the term of new alternative investment fund with Lakshya Capital. She wants to ensure that the general partners remain committed and do not exit or change strategic direction midways. Which type of clause in the agreement will protect her interest? Come on guys, start looking at the options. Read all the options, please. What is the main point? Do not exit or change strategic direction midway. Contribution clause talks about how the management fees is going to be there. This is not addressing the query. Okay. Hold up clause is nothing but if there is any dispute, okay, how the negotiation will happen, how the management of that will happen. This is wrong. C. Look at A and B. B talks about waterfall. Okay, under it comes under the economic terms to clarify how the performance based distribution will happen. Once you have made the money, how the fund cash will be transferred to GP and LP. Okay, answer is A. Yes or no? Why? Exclusivity clause. See the word, prevent funding competing fund management. Suppose there is a GP, okay, he is fund manager for 2-3 different funds, and he is basically taking a decision that, okay, which fund, suppose that he's a part of fund A and he's a part of fund B also, for example, and he has an opportunity. He's saying, I will invest through B, fund B, not fund A. Okay, so there should not be any competing clause. Okay, that you have to mention that in the contract that you will exclusively work for our fund. Okay, so pointers are being discussed over here. Let us look at the second question. Read all the options properly. Rajiv Chaudhary, a limited partner, was enticed with low management fee offered by a new investment fee. However, over time he observed that the general partner lacked investment discipline and underperformed consistently. Which problem is this? We've already talked about this. This is easy, no? Yes. Varun has got the answer. See, this is adverse selection. You did not select the manager properly. Okay, you only selected him because, okay, that fund manager was charging you lower fees, but you did not realize that he is actually not performing good. So it is adverse selection, right? Look at the next question. Prakash Jindal, he is the CFO of a company. Okay, plans to isolate a group of high risk real estate loans from the company's balance sheet to protect the core business, okay, from the potential creditors' claim in the event of financial distress. Which of the following structure would most appropriately serve its purpose? Read all the options. This is easy. If you remember, we had already talked about this from the perspective of securitization. Yes, in securitization, you create a special purpose vehicle. So we gave you the example of Citibank, all the loans. Think of it as all the risky loans which did not want to keep it on their book. So they passed it on to a special purpose vehicle. So answer is C. Answer is C. Okay, let us look at this next question. Raga Global Fund Services, Renu Mahajan is tasked with onboarding both US based and India based investor. Each investor's group face a different tax treatment. This is an important line in their country. What structure he should use? This is also easy. We just gave you the example, right? This is nothing but master fund and feeder fund. So you can create a separate feeder fund for US investor, separate feeder fund for other type of investor. Okay, and everything will go to a master fund, and from there the investment will happen. Okay, so the answer is C. Let us move to the next part, private equity fund fees and terms. Okay, some of the part is getting repeated. Okay, management fees is paid what for? Salaries, office cost and research, or the basic management of the fund. Okay, now this has to be paid. This is generally 2% of the asset under management. Okay, and 2% of the committed capital. If it's a private equity fund and the capital is committed, so 2% of that has to be paid as a management fee. This you cannot avoid because this is connected to the compensation in terms of the salaries to the management and the basic activity of the fund. So even if the performance is bad, you cannot avoid it. Okay, now look at this. In a lot of cases, okay, the fees are charged on the committed capital, not on the deployed capital. So suppose the fund manager, okay, has committed 100 crores. Okay, look at the example. But today, till now, he made a commitment of 100 crore, but till now he's only given 50 crore because the investment opportunities are only 50 crores. Okay, but the management fee will be on the basis of the overall 100 crore which he has committed. Okay, not on the actual amount that has been invested. So this is a very important part. Okay, look at the example also. Let us go towards the next part. Now, management fee can change over a period of time. This is also connected to the previous section, right? During the investment period, typically the first 5 years, what does that mean? The limited partner has given the commitment. Okay. Now this general partner is looking for opportunities in the market. He found out some company, he asked for some money and he invested. Okay. So initially what will happen? The deployment will happen of the capital. Okay. The capital will come and they will invest. This is where majority of the activity of GP will be. Once the fund is deployed, then the GP does not have to do that much amount of research or activity, right? So over here, as you move later on, after 4 years, 5 years, the management fee will decline because your activities are getting reduced. Okay. After the investment period, the fee declines and apply only to the remaining capital under management. Now think about this. Overall, the fund size was 100 crores. Out of that, okay, you have already invested 70 crores after 6 years. After 6 years, we have reached and already 70 crore is deployed. Only 30 crore is left. This is the fund that is now available. So I'm not going to pay the management fee on the overall 100 crore, but only on the remaining 30 crores. Okay. Why? Because now the activity done by the GP in terms of finding the opportunity, assessing the opportunity is going to be very, very low. Okay. That is also an important point. But all 100 crore is under GP management. No, we have already invested 70 crore in the market. Now, once you have already invested, you don't have to do the assessment with respect to which opportunity is available. So, you are only concerned about the next 30 crores. Varun, I have answered your query. Okay, the next point, double star, avoid overcharging. Okay, look at this. Some fund managers earn extra compensation by serving on the board of the companies. Okay, they invest in or offer advisory services. What does it mean? So I am a fund manager. I am investing a very big chunk, okay, of money into your company. So, and I want to understand how the company is performing. So I might sit on your board. Okay, a lot of times the investor get a seat on the board. Now, once he is a part of the board, he will be paid the board fees. Okay, he will be paid a fees to attend the board meetings. Okay, in some cases, he might give advisory services to the company, he might charge. Now, over here, the limited partner is thinking, okay, that, okay, Shubham was my general partner. I am paying him management fee. Why am I paying him? To check what is happening in the company. Separately, he is taking money from the company also. That is double cost for me, na? Because my overall return will go down. I hope everybody is clear. So it will bring in an additional investor's burden. So you have to mention that whatever extra you're earning, we will reduce when we are going to pay you the management fee, we're going to reduce that from that management fee because we don't want to get double charged. Okay, taking one more pause over here, read till this point and then we'll go to the example. Read till this point. Let us move towards the example. So let us suppose there is this capital fund. Overall amount invested is 500 crores. Management fee is 2% of the committed capital. Investment period is 5%. Now see, post 5 year, okay, we are only going to look at the remaining asset. That means out of 500 crores, suppose the 400 crore is deployed, only 100 crore is left. Okay, so after the initial 5 year, the management fee is going to be different. Okay, who is the GP and who is the LP? Look at the continuation. So in the initial first 5 year, the management fee is based on 2%, which is coming as around 10 crore. Now, how it is used? To fund employee salary, conduct due diligence. What is this due diligence? If I am GP, I am a fund manager and I'm thinking of investing into a company called Uber, I will obviously do my internal due diligence. I might hire KPMG on all of that, right? So there's going to be a cost involved to it. And obviously I have an office in very luxury location. So over there, the rent has to be paid. All of this is going to be the coming from the management fee. Okay. But after the initial 5 years, okay, let us assume only 300 crore is under management. The 200 crore is already deployed. So now the management fee is only going to be 6 crore, not 10 crore. Why? Because the workload has come down. The 200 crore is already deployed. Now you do not have to think how that money is going to get deployed. That activity is already done, right? But what are the basic costs that you still have to pay? Salaries are paid, the rent are paid, okay, but the due diligence cost will be very low now because already 200 crore is deployed, right? So from that perspective, the fees is going to get reduced, okay? So this is an example to highlight, but what can be the problem over here? Okay, what could go wrong? Look at this. To make up for this 4 crore drop, the GP, which is this Strata Capital LLP, can do one thing. Okay, now this could be problem. Okay, he can say, let me earn 2 crore in advisory fee from the companies where I've invested and 1 crore as a board sitting fee. So ideally what will happen? Okay, he's going to earn 6 crore from the management fee and the remaining 3 crores from the portfolio company. Now for the investor, he's saying that, okay, I paid you 6 crore to look at the portfolio companies and you're charging us again for that 3 crore from the portfolio company, because see, the portfolio companies are going to pay, but the overall return of the portfolio company will go down, right? So that will lead to a double payment that has to be avoided. Okay, I hope everybody is clear. So how will you do that? So you add a clause, okay, a fee offset clause. Let us assume there is a 100% fee offset clause. So the LP is going to say that, okay, you're going to earn that 3 crore from the portfolio company. So when I'm going to pay you the management fee, I'm not going to pay you that 3 crore. So your management fee is reduced. Okay, so the general partner or the fund manager is still going to earn that 6 crore. Okay, 3 crore as management fee, 3 crore from the portfolio company. Okay, how does it help? It avoids double compensation. Very, very important, because your overall return will get changed. Okay, incentive remain aligned. Now GP only focuses on the working of the fund. He does not have to be involved in the company to that level, because if I'm going to charge an advisory fee and I'm making money from both the sides, there could be a conflict of interest or there could be an issue. Okay, I'm taking a pause. There's continuation over here, but I'm just taking a pause. Are the expense related to specific investment brokerage get charged under management fee? Yes, this is a normal investment fee, no? Okay, but over here, when you look at private equity, no, the brokerage cost won't be there, because you might have a legal cost, you might have a tax related cost, because you might hire consultant. That is considered as a basic management fee. Okay, but no, real estate fund may, when I'm investing, okay, I might be buying the entire building. I might not buy few flats. Okay, so over here I'm directly going to talk to the developer. So in most cases, you will not find that there is a brokerage fees coming in. Let us move to the next part. LPs pay management fee, which is generally around 2% to the GP. Okay, this is going to cover all these costs. Sourcing deal, that means talking to the management of the company where I'm going to invest. Okay, when the investment has happened, managing that investment, talking to the companies that how the business is working. Okay, advising portfolio company, handling fund. See, all of these are activities which is covered under the management fee. Okay, so this is covering your 3%, right? Second payment, GP also receives the consulting fee, advisory fee from the portfolio company. But do you realize it's the same expense? Okay, so it's a double counting. So we need to have an offset clause to cover that. We need to have an offset clause. So this is where the example actually ends, the overall. Okay, any confusion, any query with the example? I hope everybody is good. Carried interest. Okay, carried interest is nothing but incentive. Okay, carried interest highlights that, okay, if there is a performance done by the GP or the fund manager, how much money he is going to make. Okay, if the fund performs very well, he should be given some percentage to motivate him, right? Now this motivates fund manager to maximize return, obviously, because if I know that the fund is going to generate extraordinary profit, I'll also make money, right? So in most cases, what they do is whatever is the excess return that has been generated, industry practice is that 20% will go to the fund manager and the 80% will go to the LP. The same 2 plus 20% logic. Okay, but it should meet a minimum return threshold. That is nothing but hurdle rate. If you go back to the example, the fund made 15%. What was the hurdle rate? 8%. So what is the excess? 7%. So you are only going to make 20% on that 7%. Okay, you're only going to make the 20% on that 7%. Now, how this calculation will happen? How will we calculate this 20% on the profit and all? This can happen on a deal by deal basis, or it can happen on a fund as a whole. Deal by deal means, suppose I had 100 crores. Okay, out of that I invested say around 15 crores into Ola for a few years and then I exited. Whatever is the profit, okay, if it is deal by deal basis, the GP will get the money on the basis of that individual investment. But when you look at the fund, the second option, you are looking at what is the overall profitability in that 100 crore that has been invested. Why is this important? Because suppose if I am a fund manager and I have invested into 3 companies. Company 1 I made extraordinary profit, but the company 2 I made losses. So to offset that, you use basically fund as a whole basis. Okay, fund as a whole basis. One more connecting point. We talked about the hurdle rate. This is called as preferred return. That means if you are able to generate return above that minimum expected return, that is hurdle rate, then only I'll pay you the fees, right? That means the overall return of the fund should exceed that hurdle rate, say 8%. Okay, that is preferred return. The concept of preferred return. You will only receive the carried interest or the incentive above that hurdle rate. Okay, I hope everybody is good. I'm taking a pause. There is an example also coming in. Read till this point. How is the hurdle rate decided? This is decided between the negotiation between the GP and the LP. Okay, because LP would always want to have a hurdle rate which is going to give them the minimum compensation that ideally they should be earning, okay, in the market as per the current market trend. I'm going to move ahead. There is an example. Okay, suppose there is a private equity fund, 30 crore is invested over here, and they have decided the split. If the company is going to make extraordinary profit, okay, 20% will go to the fund manager, 80% will go to the LP. Suppose they made 2 investment. Investment X earned 10 crore profit in second year. Investment Y failed and losing 15 crore in the third year. Now, how the fund payment will happen on each case is a deal by deal and the fund. Okay, remember these numbers. Investment X made 10 crore profit. Investment Y lost 15 crore. On a deal by deal basis, so you're looking at individual transactions separately. So on a deal by deal basis, when you reach year 2, this is where the investment X has made 15 crore profit, right? A huge profit. What was the profit? 10 crore profit, sorry. Okay, so they made 25 crore. Initial investment was 15 crore and 10 crore was the actual profit. Okay, now when the investment is sold and you have received 25 crore, first thing that you will have to do is you will have to repay the original amount, that is 15 crore. That is by default going to go to the LP. Now the question is, okay, how much split will happen on that extra 10 crore? Okay, 8 crore will go to the LP and 2 crore will go to the your GP. Okay, in the third year, there was one more investment, but it lost money. Okay, so losing 15 crores in the entire process. Okay, GP keeps their 2 crore, which was the initial 2 crore. Okay, so if you remember, see what is happening. There are two investments. Okay, I have invested 15 crore here. I have invested 15 crore here, both. Okay, in the second case, I have lost that 15 crore. Okay, so in this second case, the LP has made a loss. Okay, why they have made a loss? See, they are saying I have already generated 8 crores from here. Okay, that is an extra profit. But in the investment, second investment, I lost 15 crores. So 15 crores and 8 crores separately I have generated. So 7 crore is the overall loss that has happened for me. Okay, but GP, which he got 2 crore from the first deal, he is not going to pay anything. He will still retain that 2 crore rupees because the approach is deal by deal. Okay, approach is deal by deal. So what is the summary? GP is making 2 crore, LP is losing 7 crore. Okay, I hope everybody is good with the example. This entire first part, can I get a quick confirmation? Right, very easy numbers. Look at this. Now it is fund by fund. What is happening? The first investment made 10 crore profit. Second, you lost 15 crore. So what is the overall net impact? 5 crore loss. So now the LP is going to say, I am not going to pay you any profit sharing because you have lost. Right? So now in this case, the loss to LP is only 5 crore. It is not 7 crore because you're not sharing any profitability to them. There is a zero carried interest in this structure. There is a zero carry interest in this structure. Okay. Deal by deal approach is beneficial for GP, but fund as a whole is beneficial to LP. Okay. Look at this entire example. Look at the numbers part. No, it is not exactly the same that, okay, entire 5 crore will be paid by GP. Okay. It is more that if the fund is completely closed out and then if it is proved that there has been a fraud or anything, then the unlimited point trigger out. Then they will have to pay the entire thing. If that is the case, then the limited partner will make any profit every time. Because if there is a good decision, LP will make high profit. If there is wrong decision, GP will pay. So what is the risk of LP? I hope everybody is clear. Give me a quick confirmation till this slide, huh? And there is a summary also. So this is the overall summary. Okay, you can mark this for easy reference. Okay. One liner I have tried to give you an explanation. Now we are talking about the hurdle rate. We talked about the hurdle rate, right? So preferred return, okay, how does it trigger a risk taking behavior or how does it manage better performance from the GP? Okay, so what is the preferred return or hurdle rate? It is nothing but, okay, minimum this much you have to generate and then only the carried interest will come into picture. Right? Now in most cases it is compounded annually and typically set as 8%. Okay, 8% of the amount. Okay, when you're saying compounded annually, it also means that, okay, suppose I've invested $100. Okay, so in first year it is going to be 108. Next year it will increase because every year that money is also growing, right? You cannot keep standard 8%. You have invested 100 crores 10 years back and you're saying, okay, if it is growing above 108 rupees, 108 crore, I'll get the carried interest. It will not make sense because for 10 years this money was invested. It should grow, right? As an investor, you should be able to earn that minimum 8% every year. Okay. Now, how does it help? How does this hurdle rate helps? So GP or a fund manager will only make money if there is very good performance, or else they will not make money. Now there is a catch. Should I keep the hurdle rate very high? Should I keep the hurdle rate very low? Now this was already discussed in the previous slides. Okay. If the hurdle rate is too high, what will happen? Suppose if Shubham or Rahul is the fund manager and I'm saying you have to generate 25% return minimum. Now Rahul is thinking, if that is the case, I'll have to take excessive risk because then only I'll be able to generate excessive return and then only I'll be able to make carried interest, correct? So it will prompt people or fund managers to take excessive risk. Okay, he might invest into highly leveraged companies to break that barrier of hurdle rate. Okay, for venture capitalists, the hurdle rate is less relevant. Why? We see these VC funds, they invest into startup at a way early stage. So they already have a very high risk, right? So when there is high risk, they know that if I'm going to exit, my returns are going to be 100x, 200x. Okay, I'm taking a pause. Let me know if there is any confusion. All good till this point, guys? Now the next slide onwards, I need your focus. Okay, it's an important concept. Can there be, see, everything is based on that returns, how much return you have generated. Okay, so can there be a manipulation of the returns? Okay, internal rate of return, IRR, that means how much the fund has generated. Okay, so it is often used to calculate return, but it can create a perverse incentive. Now, what is this? So example will help you understand that. Okay, if the fund manager is focusing on short-term high IRR, he will maximize instead of maximizing the long-term fund too. That means he want to generate very high return in the initial period, okay, so that he can kick in the carried interest, and he's not worried about how the overall fund is growing in the next 5-10 years. Okay, that can create a problem. So let us look at the example and two simple scenarios. Okay, suppose, see, in the scenario one, what is happening? The company is trying to exit quickly. Okay, so they invested 100, the fund manager invested 100 crore, and in 6 months he got 113 crores back. Okay, so he made basically 13 crores profit within 6 months. Do you realize how much multiple it is? It is 1.13x when you calculate in terms of the returns. See, you're only investing for 6 months and you're generating 13% return. Do you realize, because it is less than a year, the overall return, the annual return will be very high. It is 25%. Why? Because you are able to get the money back in 6 months. Correct? So in this case, the overall return is going to be 25%, and now the fund manager will say, give me that carried interest. Correct? Now look at the second scenario. Hold long, but the profits are bigger, but overall lesser IRR. Simple, again investing 100 crores, but the money is coming in 3 years. But how much you are making? 126 crores. So in terms of multiple, it is 1.26. But when you calculate IRR, because the time frame is 3 years, okay, even though you have made 26%, but that 26% is over a period of 3 years. So your IRR is going to be low, right? Your IRR is going to be low. Now, in this case, when you compare both situations, scenario A and scenario B, if I am an LP, okay, I'm thinking like this. In scenario A, my overall profit is only 13 crores, but the returns IRR is 25%. I'll have to pay the carried interest. But in the second case, what is happening? Even though the overall profitability is big, but in terms of IRR, it is only 8%. So I will not have to give anything. Correct? So read this. So if you only look at the internal rate of return, then it is your process of checking the incentive is misaligned. Okay, because then what GP will think, let me follow the first strategy. Okay, invest and exit quickly so that I can earn high internal rate of return. Okay, so read this entire part, taking a pause. This example is very important to understand that concept of preferred return. I hope everybody has seen the example, two different scenarios. Okay. Now the next concept is the subscription line. Okay. Now how can fund managers boost their return? So instead of, this is a very interesting concept. Instead of using the fund available by the LP, I can borrow money from the market and invest. Okay, when you look at the example, it will become more clear. Okay, so to boost IRR, the GP use subscription of line of credit. That means they can have a line of credit from the bank and they can invest that money immediately instead of waiting for the money coming from the LP. Instead of waiting for the money to come from the LP, this will artificially inflate the IRR rate. When you look at the example, you'll understand. Okay, but what is the subscription line? Okay, basically you're having a contract with the bank and you're saying that I might need a revolving line of credit. What is revolving line of credit? Suppose a bank has given 10 crore rupees line of credit. You come, you withdraw 8 crore. Okay, you pay back 8 crore. Again, the line of credit is open for 10 crores. It is revolving. These are taken by private equity funds or even companies. If they need immediate short-term capital, they can utilize this line of credit facility from the banks. Okay. Now, how this helps? Okay. So what is the subscription line helping? So GP or the fund manager is thinking, instead of using the LP's capital, because if I have identified an opportunity, I'll have to take this opportunity to the LP. LP will check, assess, then he will say, okay, he will then deploy the capital, then I will make investment. Instead of waiting for all of this, let me go to the bank. I have the subscription line of credit. Let me withdraw that money and invest. So rather than immediately calling capital from the investor, okay, what fund manager can do? He can borrow money from the bank using the subscription line, make the investment quickly, okay, using that borrowed money, and then call the capital, call the money from the LP later to repay the loan which has been taken from the bank. This is very, very interesting, huh? But how does it enhance the return? Okay, look at this example. So there is a GP, okay, overall 100 crore. What if LP denies for that investment? See, generally the LP would not deny because the GP knows that opportunity is extraordinarily good. Okay, so in most cases it will not. That is how you know the business. Okay, so suppose there is 100,000 crore which is committed. Okay, now GP wants 100 crores in the next week to invest into a company. Now he's saying, let me not call back the LP. Let me take 100 crore from the subscription line, okay, and invest into a company. Okay, and I will call the capital from the investors. Okay, after 90 days, once you receive, you repay the loan. Okay, now how does it help in activity? This is very, very important. Mark this as star. It speeds up your investment making opportunities or investment making decision because you are not waiting for the LP's capital. So it increases speed, it gives you flexibility. Okay, first you invest and then you show it to the LP. Okay, it also improves the IRR. Okay, because what is happening? Okay, suppose now after 90 days, the capital is coming from the LP. And when the LP is giving that 100 crore, you might exit in the next 1 month. And then you will say, oh, I invested 100 crore and we got 110 crore in 1 month. So your IRR will shoot up. Do you realize? So I'll just give you a reference. Say for example, this is the time zero where the actual investment happened from the company, in the company. Okay. And what you have used, you have used a line of credit. Okay. And say for example, 6 months. Okay. This is where the LP pays. Okay. How much? 100 crores dollar, for example. Okay. And you are exiting in say 12th month, exiting from that company. So now what is going to happen to the LP? You're showing that, oh, you are only invested for 6 months. Okay. And you had initially invested 100 crores and we got say 150 crores. So now you're showing to LP that you invested 100 crores for 6 months and you made 150 crores. The returns are going to be shooting up. Okay. Returns are going to be very, very high. Correct. So this is an important point. Okay. We'll look at the example also. Look at operational efficiency. Fewer capital call because I do not have to go back to the LP again and again. Okay. It reduces my burden, reduces my operational activity. Okay. I'm taking a pause. Any query, any confusion till this point? Any query, any confusion till this point? What is the difference between line of credit versus taking leverage? It is the same thing. It's a loan only. But the loan is pre-approved. You can think it like this. Is GP acting as a market maker for LP? No. No, no. That is very different. That is very different. Okay. Let us look at this example which will help you to understand the concept. Okay. Scenario A. We are using a subscription line. Okay. GP borrows 10 crores on day one from that line of credit. After 6 months, now when the exit is going to happen, okay, you know that you're going to earn 2 crore rupees profit, because when you're going to exit, almost 2 crores will be earned. The valuation is at 12 crores. Now you call up the LP and ask for that 10 crore to repay the loan, and then you show in the short period of time you made 2 crores, right? So over here the IRR calculation is going to be very, very high, because the LP's capital is invested only for a very short period of time, right? Actual capital was invested for 6 months, okay, but LP's money was only invested for a few weeks. So over here the IRR is going to be shooting up, because you're going to say that within few weeks I made 2 crore profit out of 10 crore investment. Okay, very, very interesting. Look at this. If they do not use subscription line, so from the day one they will call money from the LP, okay, and after 6 months they will sell the investment at 12 crore. They will make 2 crores profit, but this 2 crore is over 6 months. So IRR will be lower as compared to the first scenario. IRR is going to be lower as compared to the first scenarios, right? Again, taking a short pause. Any confusion, any query? Okay, we can have a continuing discussion also. So look at this. What is the problem? In the first scenario, IRR is very high because you're using leverage to increase your return. You're not using the fund, the investor's money. Okay, this makes the fund perform very, very good, and obviously because your IRR is very high, you're going to earn that extra interest also, okay, which might not be a real return that you have generated. Okay, so the problem is this: how do you calculate the IRR? Are you using some leverage to enhance your return or not? So how do the investors look at it? They use multiples, okay, rather than IRR. Okay, a better alternative is based on preferred return on the total capital, okay, which is generally called as multiple on invested capital rather than IRR. This concept will come in the later part of the chapters also, in the further chapters. Now this prevent short-term jacking up of the IRR, because you're not looking at only the internal rate of return, you're looking at how the investment capital is growing, okay, and how much time it is taking. All of these factors are taken into account. Okay, this prevent the short-term IRR game and focus on the overall return of the fund. Now I'm taking a quick pause. Read till this point. Okay, I hope everybody is good. But the investor is still paying the fees on their commitment. So how does it make a difference for any investor beyond just the IRR? Now you're not understanding. Ideally, if the IRR is very low, you will be paying less carried fee. Barabar? If the IRR is very big, you're going to end up paying a higher carried fee. So whatever that 2 crore you have made, more money will go to the fund manager. Do you want to do that, Shubham? Right. So IRR is looked as per LP's book of account, but as per GP's book, IRR is going to be different. No. So it is basically, they need to have clarity how the fund is getting invested, how the IRR is getting calculated. If they have trust and confidence, they will pay the carried fee. No, Varun, it is not about whether the IRR is as per GP book or LP book. Okay, it should be at an overall investment level. That is what they are concerned about. Okay, let us look at the next part. There is one important concept of hurt money. Mark this as star. So if you remember, in one of the examples also we said that in some cases the general partner also has to contribute. It's not only just the LP who's going to contribute. Why? Because they want to make their skin in the game. They want to make sure that the LPs, GPs invest properly. So the standard is that the GP will invest 1% of the committed capital. Now for them who are the fund manager, this 1% of the committed capital could be very big, because it could be a very significant portion of their own personal wealth. Now, why do we do this? Why do we ask GPs to invest? Very simple logic. I want to align their interest, because now your money is also invested. So you will not take wrong decision. You will not take excessive risk, right? This is the first problem. So you cannot, first solution, that you will not be taking reckless risk. It prevents GP from prioritizing personal gain, right? What is a personal gain? GPs are less likely to abandon the fund. If the fund is not performing, they cannot leave, because your own money is also stuck, right? And you're committed long term for the growth of the fund. Okay, so if suppose the fund is of 500 crore rupees, 1% is 5 crore, which is going to come from the fund manager. If the fund loses, the fund manager is also going to lose. Okay, this concept of herd money, or the standard practice of 1%, is very, very important. Taking a short pause, read this point. So this is written in the contract. This is written in the clause. Okay. There's one more point, which is the key person provision. Okay. Now, if you remember, we said that, okay, the fund manager is actually going to take the decision. Now, over here, if the fund manager is basically left the, suppose, company, okay, or becomes very inactive, then the fund is going to suffer. So you're basically making sure that whoever are the key person in the fund, there is some clause connected to it. So now if that person leaves, or if that person becomes inactive, that person sells his stake and exit, then LP can take decisions. How? They will say no new investment is going to happen. Now we will not invest more money. Whatever commitment we had done is okay, but we will not invest more, or else we'll close the fund, or else we'll find a suitable GP to come and work. That means we'll find a replacement. So in most cases, what they do, they find a replacement. Till that time, they don't make any new investment. Okay. Why is this happening? Because now the limited partners, the investors, their money is at risk. Because now there is no efficient person who's going to run. So think about this. I invested money by looking at Rahul Deshpande, right? He is the fund manager. I know that he's very smart and he's going to generate return for me. Now he has left. So now I'm concerned how the money is going to get, how the return is going to get generated, right? So without any proper leadership, the fund might get closed, or they will find an alternative, or they might close the fund. Okay. Taking a quick short pause, read this entire section. Is an exit or replacement of LP possible during the term of the fund? Yes. Yes. See, he can sell he has some personal problems. He can sell the shares and he can go. There could be death also of a fund manager, right? When can LPs remove the fund manager? Two main clauses, mark this as double star. Bad leaver clause and a good leaver clause. Okay, bad leaver clause means there was some problem which was done by the GP. He made some fraud, or he did not follow the rules and regulation. So in this case, okay, you will not pay him the compensation. You will not pay him the carried interest on his performance. Okay, if he has violated the terms, okay, he's been engaged in any fraud, so you're going to remove him. And for doing that, you need a simple majority. But if it's a good leaver, that means he's leaving for some genuine reason. Okay, you might end up paying him the carried interest, you might end up paying him the fees. Okay, but for this you need majority approval. Okay, read this clause. This clause is considered as without cause clause. Without cause clause means there was no problem with the GP. Okay, there was no problem with the GP. Okay, so GP receives a compensation for up to 1 year, but loses all future profit. Logical, because he's not associated with the company now, no? Okay. That is the overall part. Both the points are important. Mark it as star, both the points. Okay. Why these points are added? Because the LPs do not want to be in a situation that they have hired somebody, some GP who is not performing well or some creating problems, so they can be removed, right? So fund manager also want to avoid this, because now if I have been removed from that LP or I have been removed from that fund, the news will go in the market and next time nobody will hire me as a fund manager, right? So what they do, they don't exit in between. If there is a problem, they will negotiate and restructure the deal so that there is no forced removal of that GP. This is very interesting. Okay, look at the example. A private equity fund GP is invested into risky and speculative asset. LPs have identified that and they have voted for him to remove. That is a bad lever clause. Okay, the fund is paused till that time. There is no investment till the time we get the new fund manager, right? And then the fund will again start. Okay, so this is where basically the key concepts are covered. Remember this divorce clause, how you're going to remove. Okay, and there is a summary of all of these pointers being highlighted here, which you can read to summarize the overall concept, right? Everybody is okay? Just give me a quick confirmation till this part. Very basic concepts. Now, suppose we have, I am an investor, okay, and I have invested into Varun's fund. He's a fund manager, and now Varun has made several investment into say Ola. Then you have made investment into Bharat Pay, a lot of these fintech companies and all. How do we exit from that investment? Okay, how do we exit from that fund? Okay, so that is being discussed over here. That means if I am the investor and I have invested into Varun's capital, Varun's fund, how I am going to get my money back with the profit? Okay, one is trade sale, selling the investment to another company. It is like this. We had this private equity fund. We had 10% stake in a startup, a pharma company. Okay, now I want to exit that. So I will sell this stake to some other company, or I will sell this stake to some other PE fund. This is one easiest way. Second would be do an IPO. When you do an IPO, you sell your stake to a retail investor. You get your money back 100 times, 200 times, and you then go and find some other opportunity. That is one way to exit. Look at the next one, write off. If suppose you made an investment into a suppose EV startup, and that company was initially doing very good, but then later on it went down. Okay, so you can basically write that off, because this entire game of PE funding is like that only. I have made 10 investment, only 1 or 2 will become as big as Ola, as big as Uber, okay, or as big as very bigger companies, but the rest will fail. So I will write it off, but that 1 or 2 will give me extraordinary profit. Okay, first 3 points: sale to financial institution, sell your investment to a bank or an asset manager. Suppose there is a mutual fund who is very much interested into holding some stake into DMart. I have the stake, I can sell it directly to him. Okay, now this is not a competitor. In the first point, when we are talking about the trade sale, I am basically selling DMart's share to Reliance Smart. That is a competitor. In this case, I'm selling it to the finance company. Okay, I can sell it to some other venture capitalist. Same point. See, generally venture capitalists are people who are going to enter immediately. Suppose tomorrow Rennie, one of our student, he has some unique idea, and I'm a venture capital fund. I invested in his idea. Okay, for next 1 year he was developing some prototype, and now I am feeling that this market is not that exciting. I want to exit. So I will sell my stakes to another VC, Guru. I'll send his stake and I'll exit. He will now become the VC fund for that company. Okay. Repayment of loans or share. If the investor receives preferred shares or loan, they must be repaid first. So if in a lot of cases, the investor enter at the start as it's a convertible debenture. So it is a loan which has been given to the company first, and then it will get converted into equity. Okay, suppose the company is not doing good, so the debentures or the debt will not get converted into equity. They will take their money and they will go out. Okay, they will go out. Once the exit is made, Okay, the distribution waterfall determines how the proceeds are split. That means who is going to get the money when. Okay, that means whether we'll pay the LP first, whether we'll pay the GP first, whether the management fees is paid first, whether the carried interest, that will be triggered. That is nothing but the waterfall structure. We'll be talking about it now, but I'm just taking a quick pause and then we'll move ahead. Repayment of loan. Suppose the company has taken any loans, okay, from that PE fund, because it's not only the equity, you can also give debt, right? So in that case, the debt has to be paid first. Okay. Preferred shares, if you're a preferred shareholder, you get money first as compared to an ordinary shareholder. Now, this distribution part, mark this as star. Okay, who will receive the money first, or what is going to be the order of receiving? Okay, after you have exited in any investment. Step 1, return capital to LP. Whatever was the initial investment, 15 crore I have made investment. Okay, plus any fees or expenses which the LP might have incurred. You'll have to manage that. Okay, so you will, because that's not a return, that is basically an expense done by the LP on their own. So you'll have to manage that also. Okay, some funds will only return drawn capital, money already invested, while others will return the full commitment. Now this will come later on. Okay, in simple language, you have to think that whatever was the original investment done by the LP, that is going to be repaid first. Then you will calculate the return and you will compare it with the hurdle rate. Okay, so if the hurdle rate is 8%, so 8% money has to be first paid to the LP. Okay, so LP receives the minimum return on the investment before actually GP earns anything. So if the overall return is 15%, so first 8% is paid to the LP so that he is sure that, okay, I am going to make this much amount of money. Now the case becomes very interesting. There's a diagram also in the book. Okay, this is the diagram. I'll go into that diagram. Okay, if you look at this diagram properly, okay, in this diagram, the first part is this, where you report that we have made the sale. Okay, the second part is the hurdle rate, where you paid the entire 8% to the LP. The third step is the catch-up zone. This is important. Okay, which is being mentioned here. After, read this line properly, after LP receives the preferred return, the hurdle rate, okay, the GP gets a large share of the distribution, which is the catch up of their profit share, catch up of the carried interest. Okay, now it depends upon what is the split. Okay, the split is generally 80-20. Okay, GP gets most. What is happening out of that extra profit? Suppose if you have earned 15% and you have already paid 8% as the hurdle rate, now you have 7% extra profit. Now ideally 20% of this and 80% of this should be the split, correct? GP and LP. Now this 20%, am I going to pay first this 20% or is it going to be later on? Or how, am I going to pay 80% first? That is the discussion happening. Okay, read this line. If the agreed split is 80-20, GP gets most of the profit in the phase until the final ratio is reached. Now this will get more clear as we go to the example. Okay, that is the catch-up period. Once the catch-up period is completed, okay, then the final profit is split. That means the remaining part of the profit is paid to the LP, remaining part of the profit is paid to the GP. Now you'll have to wait, look at the example to understand it. Okay, first reference, and remember, look at the numbers. Okay, initial contribution was 50 crores, $50 million by the LP. Hurdle rate is 8%. The structure is very basic. Okay, now they've mentioned that the catch up is 100%. Okay, and they have got $100 million in 2 years. So initial investment was $50 million, they made $100 million. Okay, so first step would be you pay back the original capital to him. Okay, now once the original capital is paid, your remaining profit is 8 $50 million. Second step, you will calculate the 8% hurdle rate. Okay, so on your initial investment of $50 million, what is going to be the 8% logic? It comes to around $4 million. So you are going to pay the $4 million from that remaining $50 million. What is left? $46 million. Now the third step, which is the catch-up step. Okay, now over here, the GP is entitled to receive 100% of the profit till he has earned 20% of the total profit. What is this 20% of the total profit? 20% of the total profit is 10 million. How come? Because 50 million was the total profit. Correct? And what is the 20% of the overall profit? Now this is basically a limit that they have set. What is that limit? They are saying, okay, whatever your carried interest is, okay, we will not give you that in one go. Okay, we'll start giving you till the time you reach the 20% break. Okay, so what is the total profit? My total profit is this 50 million. What is going to be the 20% share? Okay, 10 million. Okay, LP has already got $4 million in preferred return. What is that? The hurdle rate. Okay, now to reach this $20 million, 20%, okay, GP must catch up by taking $1 million exclusively, or basically 100% of the net profit after hurdle rate. Whatever is remaining, okay, whatever is that $46 million, he will first take, the GP will get the first $1 million immediately. Okay, first 1 million. Out of that overall 10 million, he's been paid first $1 million immediately. Okay, let us move forward 1 second. This is the $1 million logic. Now read over here. Why are we calculating this $1 million? How did we come to this number of $1 million? Okay, so we had total profit of $50 million. 20% was 1 million. This is a repeat. Okay, now LP has already got $4 million. The next my $5 million is profit above the hurdle rate. Okay, if suppose if the GP takes $1 million, okay, what is this $1 million? 20% of the next $5 million. 20% of the next $5 million that has been used to calculate this $1 million. Okay, that has been used to calculate this $1 million. Okay, and because if we do that, okay, if we do that, you are going to get that you have made some payment to the GP initially. You are not paying him the entire $10 million immediately. So you are paying first that $1 million, that is calculated as 20% of 5%, and then what is the amount left? 45. So initially the profit was 50 million, $4 million is the hurdle rate that has been paid. You are left with 46, then you have made $1 million to GP, then you are left with 45. Correct? Now from this 45, you are splitting it again, this and this, 80-20. Now think about this. How much the GP has made? The GP has made first $1 million and then $9 million. Do you realize GP has made the same $10 million, which is nothing but 20% of the $50 million. But the only thing is, I have not given this entire $10 million to him in one go. I have told him that you take $1 million first, then the remaining $9 million will come. I hope everybody is good. I'm going to take a quick pause. The example is continuing. I'm just going to take a pause. There is one table also over here which will summarize this entire part. So LP made the return of the capital $4 million, okay, and the 80% of the remaining profit, that gives him the $40 million. The remaining $10 million goes to the GP. He's first paid $1 million and then paid the $9 million. Why are we not paying entire $10 million immediately? Because we want, so what we are trying to do is we are trying to reduce our risk. We are saying you will get the money, okay, but in a slow terms. You will get some portion immediately, but some portion later. That is the idea. Okay, this is the bifurcation of the example. Varun, so over here what we are trying to do is, if the total profit is $1 million, oh sorry, $10 million, out of that, see, they're keeping the logic that, okay, I am supposed to have a buffer of 20% of the overall profit. Okay, $4 million is already taken. Okay, I have to structure it in such a way that it is basically getting calculated in this manner, that what is remaining 6 million. Okay, I'm saying I'll take the remaining $5 million as a base. Okay, and then calculate that remaining 1%, which is nothing but 20% of the remaining $5 million. So I'm going to pay that $1 million immediately. Okay, I'm going to pay that $1 million immediately. You have to think it like this. $10 million, this is coming as 20% of the overall $50 million profit. I'm saying out of this, $4 million is already taken in terms of the hurdle rate. Okay, ideally the entire 6 million was supposed to go to the what do you say, the owner, or basically the GP. But what I'm saying is, no, you will get $1 million first, and this $5 million will go to the LP, and then because your calculation is happening, this 80-20% is happening on the remaining amount, correct? So the initial $5 million in this is going to the LP. So they are looking at the overall $10 million, and they realize that, okay, if I have already paid $4 million, I have to give something. The number is not clear. Okay, I have to give something. Okay, the remaining part is $5 million, and I've taken 20% of that. Generally, this is calculated as 1% of the profit, which is 1% of the $50 million. Okay, I hope everybody is clear. I'll go back to the PPT and I'll address the queries till now. Why are we having the catch up? See, there is no explicit logic. Okay, you can also think it like this. Overall $50 million. Okay, $4 million is paid as hurdle rate. Okay, this is the overall $50 million, that is the profit. You're saying next first $1 million will be paid to the GP. Okay, and then whatever is the remaining $46 million, think of it like as you're giving $1 million every time. Okay, then you're saying the remaining 46, okay, I will first pay the LP, which is 80%, and then the last 20% will go to GP. See, you're thinking, I have the entire money, why I'm not giving it? No, the fund is not thinking like that. Fund is thinking for each $1 million separately. Is everybody clear? Rahul, I've answered your query. Shubham, Varun, all good? GP is eligible for carried interest in the excess of hurdle, that is 20%. 20% of $50 million. No. 20% of the $50 million. No. So what they are doing is, Varun, overall profit is $50 million. You will get 20% of this $50 million, but you will only get, okay, because you have breached that hurdle rate. समझ में आया? There's one more example. I hope, can I get a quick confirmation till this point so that I can start with the next example? No, achha, we have already talked till this point, correct? Okay, look at one more example. LP has made an investment of around 80 crore rupees. Hurdle rate is 10%. Carried interest, this is 20%. Catch up is entire 100%. Okay. Exit proceed is 1 crore 60. Now, do you realize again we have made how much? 80 crore as profit. Okay, so initial investment of 80 crore is paid back to the LP. This is the pure profit. Okay, which has to be now split. Okay, 10% into 2 into 80 crore, that comes to around 16 crore. This is the, because if you look at the structure over here, we have mentioned 10% on an annual basis, and it's a simple interest. Okay, so for every year I should be getting 10%. 10% of the initial invested amount. That comes to around 16 crores. Okay, this is the hurdle rate which the LP is going to receive. So now we are left with only 64 crore. Okay, now the catch up period and will happen. Okay, so this is kind of a repeat. What is the 20% of the overall profit? 16 crore. This is what totally the GP is supposed to get. Okay, this is the total GP is supposed to get, but he will not be paid in one go. He will not be paid immediately. Okay, I'm taking a pause. Any confusion till this number in the second example? All good? Similar concept, you have to catch up. Okay, similar concept, you have to catch up. Okay, LP got 16 crore in preferred return. LP receives 100% of the next profit until the 16 crore total is reached. Okay, from the remaining 65 crore, you're going to first take 4%. Okay, they have explained, 1 second. GP gets 4 crore. What was the logic? 20%, na? Ha. Can you see over here? 4 by 20, that is coming is around. GP's share will become 20%. GP receives 4 crore in catch up. So out of that 64 crore, we are first paying GP 4 crore. And then whatever is the remaining amount, that is 60, I'm going to split it as 80% and 20%. I'm going to split that over here. When you look at the overall amount with each party getting it, okay, so it is going to be 4 crore plus 12 crore for GP. So he is going to make 16 crore, which was also mentioned over here. He is supposed to make 16 crores. He is supposed to make the overall 16 crore. And I think we have also added a summary, which is here. 4 crore plus 12 crore, he is going to make 16 crore overall. Okay. This is the bifurcation of LP. How much he is going to make? He is going to make 144 crore. His initial investment was 80 crores. And he's making 144 crores. Okay, this is the bifurcation of the sum. I'm going to take a pause. Any query, any confusion till this point? You can check over here. It is mentioned, and this %. They are maintaining that 20% of that total 20 crore profit. Shall we move ahead? I think so. This is now almost at the end of this chapter. Are there any time delays for staggered payment for GPay? What happens to interest earned on parked money? So generally these amounts are invested in the market through an escrow fund and it earns a decent amount of return. That is also paid back. So whatever is your money, if there is going to be an interest earned on that, you'll be paid back. Okay, catch up mechanism. Okay, catch up period determines how quickly GP reached their profit sharing agreement or 20% of the profit. So we talked about 100% catch up in the previous case, right? The GP gets full catch up or 100% of the profit after LP receives their preferred interest. This is the same thing. Okay, so first you pay the hurdle rate. Okay, then you basically try to calculate how much you're going to get that amount. Okay, how much percentage of the 20% of the overall profit, how much you're going to get. Okay, so in certain cases you get entire amount in complete payment. In certain cases it is partial catch up. Okay, look at this example. If the profit is 100 crores, the GP gets 20 crores immediately after further distribution. In certain cases it is partial catch up, where we are saying I will pay only a small amount now and then I will pay the remaining amount with the payment to LP. Okay, with the payment to LP. This was almost similar to what we saw in the first example, if I'm not wrong. Okay, first and second example, where you're paying only $1 million now and the remaining amount is paid along with the LP, 20-80 percentage. Okay, the last case is very important, where they're saying you will not receive any money till the time you basically pay everything to the LP. Okay, so because he's an investor, we'll pay entire amount to him, whatever is the calculation, his hurdle return and all everything, and then the remaining 20% is paid to you. 20% of the profit is paid to you. Okay. What is the problem? See, when there is huge profit, there could be a challenge that how the carried interest is actually paid. Now think about this. If I am a GP, I am a fund manager and I am getting this last option, no catch up. That means I will be paid at the last. So I will be slightly demotivated. Correct? I'll be slightly demotivated. Okay, so there can be conflict in the way it is structured. See, LP would always prefer to get all their invested capital before GP receives, but this could create problem for GP, because GP or fund manager will have to wait for years to receive the money. Okay, now because of which, okay, this will discourage him to make good investments. Okay, so this can discourage fund manager from actively seeking strong return, because he knows he'll have to wait years to get his money profit part in the section. Okay, so GP receives a small share of profit early on, which is the second case, the partial catch up. So in the initial years, you will get some percentage, and then the remaining part is paid later, because everything is invested into the escrow account. Escrow account is nothing but an account where both the parties are involved. Okay, you might earn some interest also on that, but that account is separate account. Okay, and look at this last point. This part is nothing but a clawback provision. So 20 to 30% of the carried interest or the incentive that you made will still remain in escrow account, because if tomorrow you made bad performance, I will be able to remove that money from that escrow account immediately. Okay, I'll be able to remove. I'm going to take a pause, asking you guys to read till this point. We'll be talking about clawback provision in detail now. So Varun, what we are doing is, suppose Rahul is my fund manager. He has made certain incentive payment. He has received certain incentive. If he receives now and tomorrow he starts making losses, I have no opportunity to collect back, claw back. So in the escrow fund, that money will be kept, and out of that total carried interest, 20-30% is kept, so that if tomorrow he makes any problem, if he does any fraud, I can withdraw that money from that account and I'll protect myself. That concept is clawback, and that is basically going to come here. Okay, why do we add clawback provision? Okay, clawback ensure that neither LP nor GP receives more profit than they are entitled to receive. If suppose a GP or a fund manager gets excess carried interest early on, that means he's been able to make exact incentive immediately. Then if he makes some fraud, if anything happens, I will have to collect it from him. Okay, so LP will have to collect that money later on, which is an operational challenge. Correct. Similarly, if you disburse more amount of money to LP initially, then they will have to return. So to avoid all of this, you create an escrow account, you transfer the money, and through that you make payment. Okay, through that you make payment, so that both the parties do not receive excess amount immediately. Look at this example. A private equity fund has generally two investment cycle. When one part where they actually make an investment, later part where they start selling and get their money back. Okay, now think about this. In the early investment period, in the 1 to 4 years, the fund has performed really good and generated huge profit. But in the second phase, they have not made any profit. If there is a clawback and if there is no clawback, how it is going to impact? Okay, mark this as star. If there is no clawback, okay, the GP will earn very high interest in the first time frame. Okay, in the second time frame, he will not perform. He will not get any carried interest. But in the first time frame, he did get, right? And because there is no clawback clause, he will keep the entire profit which he made in the initial years. And he's not worried about if the fund is not performing in the second part. But if there is a clawback, okay, the LP can force to GP to return some of the portion of the profit. that you have generated in the first investment period. Okay, so clawback provision is triggered, asking GP to return some of the early profit. Okay, GP repays the excess profit and then the LP's loss is reduced. Okay, I'm going to take a pause. Example talking about the cash clawback and non-clawback. Read till this point. I hope everybody is done till this point. Now the clawback can be from both the sides. Think about this. Okay, GP clawback, if suppose you have paid excessive carried interest to GP in the initial year, then you can ask the money from that GP. Okay, so it ensures that GP does not take more carried interest than they deserve. Similarly, you can have an LP clawback. If you have disbursed more money to LP with as compared to what they were entitled to, then they will have to refund, right? They will have to repay. That is the logic. So read till this point. The first section, A and B, they've given you an example also. In a lot of cases, the payments are happening every year. After the exit also, it happens every year. Can I get a quick confirmation till this point? Is everybody okay? Let us go to the next part, which is the question. So Raghav is reviewing the fund's limited partnership agreement. He notices that general partner is entitled to carried interest and LPs are the first entitled to recover the capital plus 8%. What concept is applied over here? Look at the options. I want everybody to read the entire section, all the options. No, Varun, it does not happen like that. You have made some profit, you are immediately disbursing. No, he will get the carried interest over a period of years. What is the answer, guys? Which clause are we talking about? So he will recover the entire capital plus the preferred return, hurdle rate. So answer has to be B, no? Answer is B. Look at the second question. Samriddhi Private Equity Fund, an exit event occurred through a strategic sale. According to the fund's LPA, proceeds are first used to return all the drawn capital and expense to LP. Okay, followed by an annual rate of, this is the hurdle rate. After this, the GP receives a large share of the return until the agreed split is reached. What is this temporary phase called? This is easy. We had a specific pointer on specific slides on this. This phase where the GP receives the large share until the agreed split is reached. This is your catch-up period. Right? This is your catch-up period. Look at the next question. Niti, a limited partner has lost confidence in the fund manager strategy, although no legal wrongdoing has occurred. No legal wrongdoing has occurred. A qualified majority of LPs vote to stop the further capital contribution and dissolve the fund over the next year. GP will still receive a year's worth of management fee as compensation. What is this clause? This is also easy. It is basically testing the concept. It's a good lever clause. If there was any wrongdoing, then this A would have been the answer. Correct? Types of financial market. One more learning objective. We'll try to complete it as soon as possible. Okay. Primary market. We have already talked about this in one of the previous chapter, right? What is the primary market? Where you actually issue the security directly to the investor. You basically sell it to the investor. Okay. This is where the new securities come. So IPO is happening, where suppose DMart is going and selling the share to the public for the first time. Okay. Zomato has already done that IPO. Correct. Swiggy has also done the IPO. Okay. The secondary sale is nothing but when a company that is already publicly traded issues new share. This is called as follow-on offer. okay, where I'm selling the shares again in the market. Okay, this is also happening in the primary market, but this is not an IPO. This is basically selling, most of the time you sell it to the existing investor only, existing shareholder only. Okay, I'm taking a short pause, read and let me know if there is any confusion. Let us go to the next part, primary market. How does investment bankers help? They act as a underwriter. Okay, so they will do the origination activity. That means they will decide when you should go for an IPO, what should be the price band, okay, how many shares you should issue. Okay, they might also take the risk. That means they might buy the entire shares from the company and they will give the one lump sum amount to the company and then they will reshare it in the market. Okay, in that case, they try to generate huge profit for themselves. Over here, they are taking the risk also, because if I purchase the shares of a company at $10 and does not perform, then I will have to keep that shares with me myself. So this is also taken care by them, risk bearing. Next is distribution. If suppose I'm not doing any of these risk bearing activity, I'm just helping the company with the IPO, I will have to market the IPO also I'll have to do the marketing promotion, right? I'll have to conduct a road show so that everybody should be aware that this IPO is coming. Right? That is what investment bankers actually do. There are few securities like ADR and GDR. Okay, American Depository Receipt, you have to think it like this, that US investor, I'll give you an example of ADR, it is almost similar to GDR. Okay, suppose there is a company called Infosys. Okay, now this Infosys is traded in Indian market. Then it is not traded anywhere else. Okay, so Citibank, for example, can come to Infosys and say, let me create an ADR on your shares. Okay, so they will buy some shares. Okay, say for example 10,000 shares from Infosys. Okay, on this 10,000 shares they will issue an ADR, and this ADR is issued to the investor in US. That is what is called as American Depository Receipt, and this ADR is then listed on their exchange. Now, how does it help? So there are US investor who are buying this ADR, indirectly having the ownership of that share, and they are having the interest in the Indian market, which is through Infosys. So it has become easy for US investor to invest into Indian companies. Okay. Alternative to this, if you do not want to do this, then what will happen? Infosys, one more approach is that Infosys is listed in Indian markets or Indian exchange. Simultaneously, it can get listed in US stock exchange. Now, this is not easy activity. Why? Because you have to follow the rules and regulation of that exchange. Indian accounting standard is different, their accounting standard is different. So there can be so many complications. It is very costly. This approach is very costly. So what you can do, you can issue an ADR on the shares of Infosys and sell it to the investor in US, and you can list it on the exchange. This is a faster way of doing things. Okay. So think of it like Infosys getting traded in the US exchange without getting listed. Okay. GDR is similar concept but happening in European market. ADR is the concept which is happening in US market. So Tata Motors has issued ADR in the US, allowing US investor to buy their shares through the ADR. Okay, I'm taking a pause, asking you guys to read till this point. Let us go towards the next section, securitization. We have already talked about securitization. That means you create a pool of loans, right? These loans are illiquid asset, and then using the securitization approach, you create MBS, then you create CDO, CLO. All of these are traded in the market. So you convert an illiquid asset into a tradable security. How do we do it? I'll show it to you in the next slide. Okay, MBS is one example of this securitization activity. Okay, now why do we need to do this? Okay, suppose there are startups okay, or there are private equity backed firms. They use primary market to cash out over here, in the sense they, if suppose I'm a private equity fund and I am basically, I've already got some stake in some startup. I want to exit, so I will use primary market or IPO to exit from that, so that I will sell my shares to other investors and I will make profit and I'll leave, right? But what is the securitization? I'll come to this point now. Look at the example of securitization. Okay, so suppose there is homeowner. Okay, he has taken a loan from this originator. This can be HDFC, that home loan company, Diwan Housing Finance, India Bulls. Okay, so the mortgage over here means home loan. Okay, they have received the money, they became the owner. Okay, now this originator can pass on this entire pass on this entire pool of home loans, which is this mortgage pool. Okay, 10,000, 5,000 home loans. Okay, it can, in this is from the US perspective. So they can go to a government sponsored entity. So in US market, there is Freddie Mac, Fannie Mae. Okay, these are all companies who help in securitization, government entities. Okay, so they will basically create that securitization, do that securitization. They will create MBS, mortgage backed security. Now in this case, there is rating agency also involved who will rate this MBS. Now, why do we need rating? Because this rating will be easy for them to sell it to the investor. Now, once this MBS process is happening, you do not keep that entire pool in your book. You basically pass it on to your special purpose vehicle. Over here, I have named it as a dealer or an arranger. Okay, the moment you pass this entire pool, pass this MBS instrument to dealer, you receive the money, you become free, you can give new loans. Correct? Now this special purpose vehicle will sell this to investors or asset managers. What? MBS. They are not selling the pool, they are selling the MBS. And in return, they will generate money. Okay. Now whenever this homeowner is going to pay the EMI, principal and interest, okay, there is one servicing agent sitting in between who will collect all the money, he'll do the accounting and all. And that money is passed on through this government sponsored entity to the final investor. That is a return on their capital which has happened. Okay, I'm going to take a pause, read till this point, and let me know if there is any confusion. All good, guys, till this point? Ronak, Dipti, dealer is created by the originator. In most cases, yes. This is one example. Huh? In most cases, yes. All good? Let us move forward. Now, what is secondary market? Secondary market is where the investors are basically selling their asset. Suppose I purchased I participated in an IPO and I got shares of Zomato. Now I want to sell it to somebody else. So very popular secondary market is exchange. If Zomato is listed on NSE and BSE, I can sell their shares directly through that, right? So most of the companies are listed on NSE or any one of the exchange, and through that I can sell. This is secondary market. Now, why this is so much important? Now, if there is no secondary market, your primary market will fail. How come? Think about this. If tomorrow Shubham or Varun wants to buy the shares of Infosys or shares of Zomato in the IPO, but if they know they will not be able to sell it in the future to anybody, they will not buy, right? So secondary market is very, very important because it provides liquidity to investor. Whoever has already purchased that share, now you can sell that share, or somebody new wants to buy, they can also buy. Further, it helps in price discovery. At the time of IPO, the shares were sold at 100 rupees. Today, what is the demand of that share? What is the current price? That you will come to know because it is listed on an exchange and the price is continuously tracked. Lower cost of capital, right? Because it's a liquid stock. That means it is listed in the secondary market and you can sell it immediately. Investor will be interested to come and buy that share in the IPO, right? So it is easy for you to raise money because you know there is a secondary market which is available. Okay. Take a short pause, read this entire section, right? Let us look at this. Few market participants in the secondary market, market maker or dealer. We have already talked about this. If you remember, bid price, ask price, right? If you want, dealer is available in the market to sell and also to buy. Okay, he will earn that bid ask spread. In the previous chapter, we talked about this, right? Okay, so there are dealers, there are brokers also. Brokers are nothing but he's just facilitating you to buy and sell. So in simple language, Zerodha, your Sher Khan, IIFL, Upstock, all of these are brokers. Okay, but dealers are going to be big banks because they have the appetite to buy and they have the appetite to sell. Okay, now in the book, they've given you the reference of different types of order, market order and limit order. You have to think it like this. If the current share price is 100 and if I put a market order, then whatever is the next price, the transaction will happen with that. Next price can be 110 also, it can be 90 also, it can be 99 also, it can be 105. I have no clarity because whatever is the next price, the transaction will happen. This is market order. But when you look at limit order, suppose the current price is 100 and I want to sell. So I will put a limit order which is going to be higher. Say for example 110. So if the stock is going up and down, if it touches this 110, it will be sold in the market. So it should touch that specific price, then the transaction will happen. That is your limit order. Taking one more short pause so that if there is a query, we can address it now. I hope everybody is good. Let us look at this. There is third market and fourth market also. First, we'll be talking about the third market, trading outside the stock exchange. Okay, that means outside the formal exchange. Then we are talking about OTC. What is OTC? We have already talked about this. Transactions are happening over a call. Everything is recorded from between the two parties. There is no exchange, nothing. There is no clearing out sitting in between. Okay, suppose there is a mutual fund who wants to buy 500 crore worth of share of HDFC. Instead of going to NSE, he will directly buy it from some other bank who has that 500 crore worth of share. Right? Why? Because I do not want to do this entire transaction on an exchange because there's going to be a huge cost to me. Okay, this is a third market. Look at the fourth market. Okay, allowing investor to directly trade with each other without any broker or any exchange, but on an electronic platform. This is also called as dark pool. Okay, they use electronic networks. This is not exchange, their own network, and through that they basically make a transaction. Okay, this is similar to an OTC. Okay, but over here the transparency is low in the sense you don't know with whom you are doing the transaction. Okay, it reduces the transaction cost, improve privacy, because if somebody knows that there is one big transaction coming up from say JP Morgan, the market will become active. If JP Morgan is buying, I'll also buy. So to avoid that, they do transaction on these networks. Okay, and they are also active after the trading hours, because if you look at exchange, after 3:15 the transactions are not happening. There's a cutoff time. But over here you can have transaction any given point in time. Okay, electronic and communication network is used to match buyer and seller and do the transaction. There is no broker involved. There is no broker involved over here. Okay, there can be a broker in the OTC market. There can be. Okay, but in this case there is no broker. I'm going to take a short pause, asking you guys to read till this point. Few examples of these electronic communication network. This has just been added for your reference. Example 1, example 2. You guys can read. Okay, LIC, SBI mutual fund, they use this network. They have their own clearing and settlement agencies. Yes, they are not clearing settlement. They are just a platform, right? More details about it. So few more example. Okay, third example. Have you guys heard about high frequency trading? Okay, so basically algo trading. There is no human intervention. Algorithm itself is buying and selling depending upon what is the news in the market. What is the sentiment in the market, right? So they trade large volumes in millisecond. A trading firm buys and sells Reliance share thousands of times per second to make small profit in the entire. This is only happening because of the algorithm that you have set. Alternative investment assets are often traded in private market rather than on an exchange. We already know about this because suppose real estate transaction, it will not happen on an exchange, right? It's happening on the private market, so between two participants. Okay, now there is a bigger problem in this. What is that? There is no transparency because on an exchange you can see the price. When you're doing the transaction with each other, there could be information asymmetry. You don't know what is the actual price of the asset because one party has more information than the other party. So the deal can break, correct? So some investor might have higher information as compared to the other, and hence there is very, very low transparency and also low regulation. So good chances of fraud happening. But because the transaction is happening within you and me, you can do the transaction immediately and make the payment. You don't have to wait for exchange T+1, T+2 settlement. Transaction can happen very quickly. You can negotiate and customize the transaction. Okay. And you might do it directly, so hence there is no broker, no third party involved. You can immediately do the transaction, right? I'm taking one quick pause over here. There's one more final section which is there. We'll cover that. Read till this point, everybody. Let us look at the last part over here, which is short selling. Okay, how does short selling work? So if I want to do short selling, I'll have to first borrow the stock. Most of the time it's going to be broker. I'll borrow the stock, I'll sell it in the market, I'll wait for the price to go down. When the price goes down, suppose I've sold at 100, price is gone down to 90, I'll buy back and then I will return that loan, return that asset to the broker. Okay, so the concept is very simple. I am going to sell high and buy low. Okay, I'll buy back at a reduced price and then I will give it to the broker itself, the stock. So whatever I have borrowed, I have repaid, I have given it back. Okay, so then it goes back to the original owner. This is a simple plain vanilla short selling, but what are the implications to it? Okay, let us talk in detail about it. Look at the example. I have purchased 100 shares at 500 rupees. That means my total short selling amount is 50,000. The stock price goes to 400, so I'm going to make 100 rupees per share in that, right? That is going to be 10,000. Obviously, there's going to be some cost and fees. What is the cost? Brokerage cost, transaction cost that I'll have to pay. Plus, there could be some other fees also. That means a broker has lent you that stock, so he might charge a fee for lending you that stock. That also has to be removed. Then only the profit is calculated. Any confusion till this point? Short selling, any confusion? All good? Look at this part. Who provides you with the borrowed share? In most cases, the brokers, because they have the stocks in the street name. What is the street name? Dalal Street, Wall Street. So they have an account. Okay, so whenever you do intraday transaction, okay, which is ideally supposed to be bought and sold, that stock is in the street name with your broker. If you do not, suppose you purchase the stock and you are not selling it, he has the right to sell it because the stock is not in your name, it is in the straight name. Okay. Now, in between, the broker can use that share to lend it to somebody. Okay. And he can earn some fees from that. That is also possible. Right. That is also possible. For how long you can borrow? So now it entirely depends upon the market. In India, the stock market, you can borrow it for 1 day. Okay. Now, what is the concept of dividend? Now think about this. There is a broker over here. There is Mr. C. He was the original owner of that asset, some stock. Okay. And he has a relationship with the broker. That asset is here. Okay. And now there is Mr. A who wants to do short selling. So he has borrowed that asset from the broker. Okay. He has entered into a transaction with Mr. B, okay, in which he is giving the asset he's getting the dollar. That means he's doing short selling. Okay. Now, obviously, he will buy back when the price goes down. But suppose in between there is a dividend that has been announced. There is a dividend which is announced on this asset. So what will happen? Because see, the asset is already available now with Mr. B. So ideally, the company, the stock, okay, suppose this stock was DMart. So DMart will issue dividend to him, but Mr. C will lose, na? So what ideally we do? Okay, whenever Mr. A is returning back that asset, he also has to give the dividend, because Mr. C, who is the original owner of that asset, he is losing on that dividend, right? So when at the end Mr. A will have to return that stock or that asset, he will have to return the dividend or pay the dividend or any income on that asset during that period, plus there will be a borrowing fees which you will have to pay to the broker. All of this has to be paid. Okay. So if there is any dividend, that has to be paid back to the original lender, so that it does not create any confusion, because Mr. C, who was ideally supposed to be the owner, his stock has been used and given it to somebody, he should be getting that dividend, right? So to avoid any dividend irrelevancy, because the original owner is also receiving the dividend now, and who is paying that? Mr. A is paying that. Okay, I hope everybody is good. Look at the cost and the risk. Now, what is the risk involved in short selling? When you do short selling, you expect the price to go down, but if it goes up, then you're going to lose, right? Then the broker will call you, give more collateral, more money, and the risk is unlimited. Why? Because the stock price can go very higher, right? So over here, what brokers do? If you're going to do the short selling, you'll have to take there is a collateral requirement. Okay, that means you'll have to give some asset. Okay, so short seller must deposit collateral to cover any potential loss. And generally, if I'm giving an asset, there is a haircut which is applied. Okay, let us assume that the haircut is 2%. So if I am giving for example, I want to sell shares worth of 50,000 rupees. So I will have to keep a collateral which is that 50,000 plus 2% extra. That is going to be 51,000. Why? Because I need to have some buffer. I cannot have the exact same value of that asset and the stock that you have sold. Okay, because stock price can fluctuate very fast and then there can be a loss. So to avoid that, you keep that haircut. Okay, I'm taking one small pause over here, asking you guys to read till this point. Any confusion, any query till this point? All good? Cost and risk of short selling. Okay, so when you borrow the stock, okay, the lender earns an interest on the collateral. What does this see? You have given a collateral for doing short selling. If the lender is going to earn some interest, he should be paying back to you, right? That interest has to be shared. But what the lender is going to think, the broker is going to think, oh, I have given you the stock, right? There is going to be some brokerage fees. So whatever interest I'm supposed to pay you, I'll minus the rebate. Rebate is nothing but, okay, the, what do you say? The borrowing fees. You have to think it like this, borrowing fees. Okay, so lender often share a portion of the interest with the short seller, but he's not going to pay the entire amount. He's going to say, okay, I'm supposed to charge some borrowing fee to you, right? So I'll reduce that and then I'll give it to you. That is the logic. What is this forced buy-in? Okay, now very simple. Say, suppose Rahul has seen a stock at 100 and he's saying, I will sell short it. Okay, I am expecting the price will go to 80. Okay, and immediately suppose price went up or suppose it went slightly down. Okay, he's done the short selling. Now the broker is saying, give me the stock back. That means the broker is forcing him to close a transaction. Correct? So in that case, he will have to buy back the stock immediately, even at a loss. The price immediately went up, or suppose after some time it went up. I was expecting the price to go down, but I've been forced to buy back at a higher price. because the broker need that stock immediately. Okay, the broker, this is called as forced buy-in, forcing you to buy back the stock. So what is the solution to this? Some short sellers use term loan which lock in the borrowing for a fixed period to prevent buy-in. That means I inform the broker that I will basically not be able to give you the stock back for this much period of time, and you charge me whatever you want to charge. Okay, so it's kind of a loan that is for a particular term. Okay, particular time. Now there was a concept difference between a brokerage fee and a rebate fee. Brokerage fee is the fee that I'm charging you to do the transaction. Rebate fee is the fee that I'm charging because I'm giving you an asset to sell, right? Look at this next part, dividend irrelevancy clause. When a company pays dividend, the stock price will go down. This is by default. Why would the stock price go down? Say if the stock price was $10, okay, company has given dividend. That means the cash has gone down in the company. And this $10 was reflecting the overall wealth of that company or the value of that company. Now from that value, the cash component is gone. So whatever dividend you are giving per dollar, the value of the share will also go down by that. Suppose if the stock price was initially 100 and the dividend is 5, now after the dividend is paid, the stock price will remain 95. This is by default. Now see, if this is going to be the case, then the short seller who has already sold at 100, he is immediately going to make $5 profit. But do you remember, if there is a dividend, the short seller will also have to pay that $5 to the original owner. So he is not actually making any profit, even though the stock price has gone down. Correct? I am taking a pause. Let me know if there is any confusion with respect to this dividend irrelevancy. Marking this a star also. All good? Some unique concepts related to short selling, special stock and high borrowing costs. Now suppose if the stock is in very high demand in the market, then it becomes a special stock. If I want to borrow, I'll have to pay a very high borrowing fees. Okay, because that stock is very high demand in the market. So nobody is willing to give you that stock. If you want to get that stock, you'll have to pay a very high borrowing fees. In extreme cases, look at this. In extreme cases, the short seller must pay the lender instead of receiving a rebate. Okay, what is this overall logic? See, if you remember, we said interest minus the rebate. So ideally, you are supposed to make some interest component on the collateral that you're going to be posting. So short seller might say, I don't want any interest. You take the interest. That's a negative situation for the short seller because I'm in desperate need of that stock, desperate need of that asset. Okay. Crowded short and high borrowing cost. If there are many investors who is doing short selling, what will happen? Everybody will move in the market to close their position. That means they will buy. And when they start buying, the price will go up. Second, because everybody is going and buying, there are very few stocks which are available. Correct? That is nothing but crowded short situation. Because then your overall cost will go up. These are the first 2 points. There are more. Taking a pause, read till this section. Are the pre-dividend future prices also adjusted post-dividend event? It is not going to impact the future price. Okay, because what will happen? See, if the stock price goes down, the future price will by default go down. So only dividend is not impacting it. So we have talked about the first 2 points. The third point is connected to the bought-in, forced closing of the short position. Okay, when a stock is in high demand for short selling, available shares to borrow becomes very, very scarce. That means very less stocks are available. So if the inventories are very low for the broker, he might say that, okay, you have already done short selling now, I need my stock back. He will force the short seller to buy back the stock. Now, if this is going to be the case, and if the short seller is not interested to do, he will have to do it by taking a hit. That means he might incur a loss and still he will have to give the stock back. Okay, because in that case, why is broker forcing you? Because in most cases, the original owner wants to use that asset, and the broker has already lent that asset to somebody. So in that case, the broker is going to force the short seller to close. Okay, this is brought in. This is the forcing happening from the broker or the lender. What is the next situation? Short squeeze. You can mark both of them as star. Huh? What is short squeeze? You have taken a short position at 100. Instead of price going down, it increase. When the prices are going up, your losses are very big. So you are now forced to buy back at a high price. Okay, you are forced to buy back at a high price because the price is going high. Read till this point. There is one example of the short squeeze. So GameStop, many hedge funds have taken short position on this GameStop. They were expecting the prices will go down, but retail investors started buying heavily to this stock and the price went up. When the price went up, these hedge funds were started making loss and they had to buy back at a higher price, and they lost billions of dollars in this short squeeze incident. Okay, example just to connect the dots. What is the overall risk in the short selling? Very simple. Okay, there can be unlimited loss because if the stock price goes up, it can go up to unlimited. Second, you have to pay the dividend. If there is any income or dividend, you will have to give that dividend to the original owner. Correct? There can be margin calls. Now, when the margin calls will come, see, you have given a collateral. Okay, when the price was 100, now the price has gone up. So the broker is going to say, either you give higher collateral, more collateral, because the price is going up, or else you buy back the stock and give it to me. Buy back the stock and give it to me. So this is one more problem, margin call. Okay. Short squeeze risk, we have already talked about this. The price is going up and now you are forced, because you do not want to take more risk, you are forcing yourself to buy back at a high price. Okay. But this short selling will give you higher potential profit also. If suppose the stock price goes down very high, like for example, Hindenburg case, Adani, when there was a news, the stock went down, you could have done short selling and you could have made huge profit. Okay, I'm taking a quick pause, read till this point. Prachi, answering to your query, when broker forced to lender, is there any immediate charges held on by broker by lender? No. There is no specific charges. Basically, it's a market demand and supply which is impacting. Okay, I've answered the queries. Look at this first question. Ritesh Ahuja, he's looking at initiating a short position in the share of this company just before the company's ex-dividend. He is aware that he must pay the substitute dividend to the lender. Despite this, he maintained a position expecting a price drop. What justifies his strategy under the concept of dividend irrelevancy? Read all the options. What is the concept of dividend irrelevancy? See, whatever is going to be the reduction in the price, you have to pay the similar dividend, right? Correct, no? So read this. Dividend payment to the lender is offsetted by the stock price drop. So whatever your profit you're making by the stock price drop, you're paying it to the lender. That is your dividend irrelevancy logic, right? Answering to your query, Varun, is the short selling done for a very short period of time? It can be one day. It depends upon market. Okay, it can be for a longer period also. Okay, it is for the longer period. Ankush is a trader. Okay, he has shorted a stock that recently gained popularity. As more investors try to short the same stock, the cost of borrowing is going to increase. Now he faced near zero rebate. That means he will have to pay extra. What is the most accurate classification of the stock in this scenario? This is easy. This is a special stock because there is high demand for that stock. Right? One more question, Meenal. She wants to buy share of this, but only if she acquires for $250 or less. She places an order that will only get executed when the condition is met. What kind of order is this? This is also easy. Is it C or D? She wants to acquire, that means buy. It is not short selling. So that is wrong. Answer is limit order. You will only be able to buy when it reaches a price of 250. Right? One more question, Priya. An analyst identifies a heavily shorted stock and initiates a short position. After a few days, the stock price unexpectedly goes up. Then the broker notifies her that unable to manage the inventory, price is going up. She is now forced to close her position. What is the situation that Priya is facing? This is different. Last question is very different. Yes, it is buy-in trigger by the inventory shortage at the broker end. Correct? Right, so answer is B. And with this, we have completed the chapter.